Hi folks, my name is Lukman Otunuga, Senior Research Analyst at FXTM, and today I'm joined with Han Tan, Market Analyst based in Malaysia. I want to welcome everyone to the last monthly outlook for December, trading opportunities amid a dark winter. Now, before we proceed, I'd just like to confirm if everybody can firstly hear me and Han properly and also see our screen. I'd like to see a show of e-hands if you can hear us and see us properly.
Here, mic check 1 2 1 2. This is Han Tan coming to you live from Kuala Lumpur, Malaysia. Yeah, so feel free to raise your digital hands, and you can find that on the right-hand column of the toolbar of sorts that they have in GoToWebinar. So if you can give us a show of hands there, that you can see the PowerPoint screen, you can hear myself, you could hear Lukman's intro. That'll be great. Still not seeing any hands yet. So, wonder what's going on there.
Yeah.
Mic check 1 2 1 2. Can you guys hear us? Please raise your digital hands, which you can find. There we go. Thank you for those hands. We see a couple of them. All right, great stuff. All right, back to you, Lukman.
Perfect. Thank you. Good stuff. So before we proceed, I'd just like to, share a quick disclaimer with you all. So the content presented compromises of personal opinions and should not be construed as trading or investment advice. Trading forex and leverage financial instruments involves significant risk and can result in a loss of your invested capital. You should not invest more than you can afford to lose and should ensure that you fully understand the risks involved. Trading is risky at all times. Before I hand the mic over to Hannah, I just think we all deserve a pat on our backs for such an eventful year. So much has happened in 2020. I mean, the webinar was titled Trading Opportunities Amid a Dark Winter. Due to the various forces pulling and tugging at global sentiment. So on one side of the equation, we had this explosive levels of optimism over a coronavirus vaccine, returning the global economy back to some sense of normality. But the other side of the equation, there is these surging coronavirus cases in the United States and parts of the world, and threat of a renewed lockdowns really hitting the global economy and darkening the mood. On top of this, there's recent news that we actually have renewed US-China tensions, which could create more volatility as the final trading month of 2020 gets underway. It'll be interesting to see what all this means for financial markets. But without further ado, I will hand over to Han.
All right, great stuff. Thanks so much, Lukman. So the reason we chose the title for Dark Winter is because it was something that Joe Biden had used. Remember, President-elect Joe Biden had used in the lead up to the November 3rd elections. Seems like a lifetime ago now, hey, Lukman, that we had the US elections, although it was just about a month ago. Right, so it was something that he used, and also in the aftermath, he warned about it, because of what the U.S. is contending with in terms of the pandemic. So we decided to leverage on that and then put it in quotation marks. That's what you saw as the theme for this webinar. Excuse me. But having said that, if you look at the S&P 500, well, maybe not so much a dark winter after all. Right. So if you look at some of these factors, there are more things that are pointing to the upside more so than the downside. Okay. So for example, the first bullet point there, you got a vaccine-enabled economic recovery. So we know that the UK is the first Western country to approve Pfizer's vaccine, and possibly more to come. We've got two other candidates, one from Moderna, and then the other one from University of Oxford and AstraZeneca. So those should get approved in the near future as well. That's what markets are expecting. This week, on December 10th, the US FDA is set to have a meeting whether or not to approve the Pfizer vaccine, and markets are expecting them to do so, right? So all that is fueling a lot of optimism, like, hey, the US economy is reopening, so these are the kinds of sectors that can benefit. Okay, I just want to draw your attention to the bar chart, the horizontal bars that on the right side of our screen. So if you look at the S&P or sectors within the S&P 500, if you look at the performance since October 31st, so basically since November until this past Friday, you will note that the energy index and the financial index, financials being banks, yeah, they are the top two performers, okay, over the past few weeks. Now, this is important because if you look at it from a year-to-date basis, and I'm going to switch over. So you see, this is the year-to-date. Look at where the energy and our financial indices are. They're at the bottom. All right. So this is because during the pandemic, and we saw what happened with oil prices. So obviously, stocks that were linked to oil prices fell big time. Okay. On top of that, with banks as well, with the Federal Reserve cutting interest rates, long story short, it makes it that much harder for banks to try and make profit. Okay. So, because of that, you had these two sectors that really got hit hard. But then, as we saw earlier, over the past few weeks, going back to this one, right, you see how energy and financials are just soaring. Okay. This is predicated on hopes that with a vaccine being rolled out into the US economy, potentially even by this week, they said that within 24 hours of approval, they could roll out the vaccine into the US. That can boost confidence, right? People feel safer to go out, get on planes, right? And just go back to life as they once knew it. So that is why you've got energy, financials, industrials, like these kinds of sectors that have just really surged over the past few weeks. Okay, now really quick, going back to the bullet points, some of the other things that are fueling the risk on sentiment in global stocks. So there are expectations that the US government will roll out more stimulus. What that means is they've got potentially hundreds of billions, if not over 1 trillion. We don't know how much the final figure is yet. They want to roll out more financial aid into the US economy to help businesses, to help protect workers, right? So when these economic agents, businesses, folks, all these different economic sectors, they've got more money in hand, hopefully they can then spend it, okay, and then help boost or prop up the US economy. So that's happening as well. Obviously, you've got plenty of expectations for a smooth transition to a Biden presidency. We will know when President-elect Joe Biden will be sworn in on January 20th or 21st. I can't remember the exact date now, but he'll be sworn in then. So markets like stability, right? We know that. Markets like certainty. So, with that in mind, they can then plan ahead. And then last but not least, you've got major central banks, that's the Fed, the ECB, etc. They are looking to provide more policy support. So look ahead to the European Central Bank's meeting this week on Thursday. They are widely expected to announce more support for the EU economy. And then same thing for the Fed next week, December 15th, 16th. They are expected to roll out more financial support for the US economy as well. Okay, so all that spells more upside for stocks, including the S&P 500, which is an index. Okay, now I wouldn't be doing my job if I didn't give you both sides of the story. So not everything is looking upwards. If you look at the downside, some funds might be, trying to lock in some year, excuse me, some gains after this stellar climb since March in equities. So that could be some dampening effect, or in other words, it caps how much these US stocks can really climb. So that could be in play. If you look at the technical side, though, there are plenty of technical indicators that are pointing that a pullback over the near term is in order. Everything from Bollinger Bands to the RSI, Relative Strength Index. Now, folks, if you're not familiar with those terms, I highly encourage you to head on down to our website. It's FXTM.com. On the far top right-hand corner of the website, you've got a segment there for market education, a whole glossary there for you to find out about how you use RSI, Bollinger Bands, etc. Okay, but that's on the technical side. For the downside, though, when it comes to valuations, I think the valuations are a bit too high, especially for the tech stocks. I mean, if you look at Tesla, I had this number off the top of my head, but let me just try and pull it up here real quick. So, for example, for Tesla, right, you would have to pay, I think over $600. Let me see, PE. Oh no, it's higher now. So you would have to pay $949, $949.11 to be exact, to access just $1 of profit that Tesla earns. Okay, that's how much the valuations have just gone crazy, right? So, if markets decide, no, that's just gone on too far, there's got to come back to something more normal, then we could see a pullback there. Keep in mind, say the long term, speaking about the S&P 500, the P ratio, the average P ratio is about 20, 20-ish, all right? Tesla's P ratio right now is 949. That shows you how overstretched, and that is an understatement, overstretched valuations are. And then, like Lukman said, we could see some negative shocks in the global pandemic. We have already seen some noises about the US-China trade tension, so we'll see how that pans out, okay? So let me just wrap up the S&P 500 with this. All right. So if you look at the performance from January 1st until November 30th, it's gained 12% in the first 11 months of this year. So if you look at the average gains for the S&P 500 for the month of December alone, okay, over the past 20 years, so that's the 20-year December average, it's about 0.55%. Okay, so I mean, granted, these are unprecedented times. We could be seeing a Santa rally. How many of you have heard of a Santa rally? If not, you can just Google off to the side right now. Santa rally, that's a term that we often hear in December. So, generally we expect more gains for the S&P 500. How much more? I think that's a big question here. In my view, I think that's limited upside. But then again, who knows, right? These are unprecedented times. So real quick key dates that I mentioned earlier, this Thursday, December 10th, the FDA is to maybe approve the Pfizer COVID-19 vaccine. Then next week, we've got the Fed policy decision. Here's a fun one, December 21st, Tesla is set to start trading as a member of this blue chip index. Blue chip index meaning like this is an index, it measures, right, the performances of all these big big market cap stocks. Okay, so Tesla has made it to the big boys club. So there is plenty of speculation that December 21st could see a lot of volatility because, fund managers have to move things around to the tune of $70 billion, right, to try and fit this big elephant in the room that is known as Tesla. So look out for that. Should be fun. All right. So those are some key days to look for. So long story short, I do expect more upside for the S&P 500. Will it hit 3,800? I think that's a bit of a stretch. Possible, but in my view right now, perhaps not so likely. Okay. All right, so that's it for the S&P 500. So let's go over to the dollar with Lukman, which is actually gaining a little bit as we speak right now, back above that psychologically important 91 level. Lukman.
Thank you for that, Han. Thank you. Yep. As to the dollar, let's be honest. I think from just looking at the dollar's valuation, 2020 has not been a kind year for the king of the currency markets. It remains depressed, unloved, vulnerable. I can go over the adjectives to describe the dollar, but just to cut a long story short, the dollar has been in the dumps over the past few months. So I've got key drivers that have really influenced the dollar's valuation. There's this risk on sentiment fueled by the vaccine breakthrough. So, we've seen a theme this year that the dollar has been one of the hotspots of safety. So when there was a lot of uncertainty, everybody rushed towards the world's most liquid currency. But as the market improved, and we had all these good news revolving around the coronavirus vaccine, and at the same time, optimism jumped over the, outlook of the global economy due to the vaccine. It seems investors have taken a step away from the dollar and focused their attention towards riskier assets. That's why we can see the S&P 500 and other equity markets pushing higher. There's actually renewed hopes of a COVID-19 stimulus package. I mean, this has been an ongoing theme. The latest reports actually show that a group of senators have actually are set to unveil legislation as soon as today for additional fiscal stimulus worth about $908 billion. So that's a big deal. That's quite serious. And the reason why this is going to impact the dollar is because as the stimulus, provides that critical lifeline to households, businesses and supports consumption. The fact that it could result in higher inflation, this may end up weakening the dollar. Thirdly, Hans already spoken about this already. There's speculation around the Federal Reserve possibly expanding quantitative easing. I don't probably may not be in December, but it could be sometime in 2021. The Fed has already said that they're going to leave interest rates unchanged for all the way until 2023. So I think that the next key thing to stimulate the US economy could be more QE. And it's the same theme, as the central bank simply purchases government bonds or financial assets, they're basically injecting money into the economy. And that dollar liquidity, that more supply of dollar, ends up weakening the currency. And fourth, surging coronavirus cases in the United States. When we look across the world, this has been one of the key themes. Just on Friday alone, the United States actually hit a record number of coronavirus cases with a single day count jumping over 228,000. This is really hitting sentiment towards the largest economy in the world. And as fears continue to rise over the economic outlook, this is translated to a weaker currency. So I've spoken about the key drivers, but I think if there's a light at the end of the tunnel for dollar bulls or possibility for the dollar to bounce back before the end of 2020, it could be the fact that now we have renewed tensions between the United States and China. Naturally, this return of uncertainty may send investors towards the dollar, and it could provide, some sort of support and limit the downside. To my right, I've got an interesting chart showing the dollar's performance over the past 20 years. And the dollar right now, year to date, is of course depreciated. The dollar index, weighted year to date, is depreciated over 5%. The last time the dollar index actually concluded the year negative was back in 2017, and before then it was back in 2011. So this is quite significant and it's quite a big deal. Just to cut a long story short with this, there's no love for the dollar, and the current themes may ensure that dollar weakness may remain a key theme for the rest of 2020. I've got potential performance for the dollar index, technicals, as they say. Fundamentals are quite fun, but a picture says 1,000 words. So I've got some charts on the next webinar slide to discuss the key technical levels for the dollar index I'll be looking at for in December. So I've got a daily and weekly. So if I was to go ham 400% technicals, you can see that there have been consistently lower lows and lower highs on both the daily and weekly. Prices are trading below the 20 and 100 simple moving average in the daily, and that strong decline below 92 may open the doors towards 90.0. Towards 90. On the weekly charts, it's the same picture. There've been consistently lower lows and lower highs, and prices are actually respecting a weekly bearish channel. And you can see there's a strong level of resistance below 92. As long as prices are unable to break back below this key resistance level, the path of least the resistance for the dollar index points south. So in a nutshell, dollar weakness may remain a key theme for the rest of 2020, or for the final few weeks of 2020. Thank you.
All right, great. Yeah, so I think that weaker dollar bias is set to remain intact for 2021, yeah, but it really depends on what the Fed does as well. So I know some of these things that we're talking about might be more on the longer term outlook, and I know you guys, those of you who trade, might be more focused on the 5, 15-minute or 30-minute charts. But what we're offering here is more of a fundamental outlook laced with some technicals. But from a fundamental perspective, yeah, that I'll be really, really shocked if the dollar just, starts strengthening back to 94, 95, kind of levels. Okay, so I expect that dollar weakness bias to remain intact. So with that said, we're going to look at gold now. How many of you have heard this saying that, oh, gold is a safe haven asset? Can you raise your digital hands if you are familiar with that concept? Yeah, gold is a safe haven asset. All right. Yeah, I see a couple of hands. Thank you. Yeah, a couple of hands. So for those of you who are perhaps not raising your hands, either you're never heard it before. So gold is seen as a safe haven asset. What does it mean? So it means that when investors are fearful, they would then flock to gold. Why? Because it's seen as a great way to preserve your wealth. Okay, so we saw that in March this year at the height of the pandemic. Then in August it hit a new record high, right? And you saw this uptrend for gold prices as well over the last couple of years, given the U.S.-China trade tensions, right? So that's the narrative around gold. However, okay, over the past few months, gold's status as a safe haven asset has actually taken a backseat big time. Okay, the dollar has clearly been the preferred safe haven asset. Okay, so now given what you've heard from Lukman and myself, right, we are talking about risk on sentiment, a lot about the vaccines, right? So people are investors are more comfortable buying riskier stuff in the markets. So you are seeing this weaker dollar story because the dollar again is the well, I would say the favorite safe haven asset, right? Gold status had actually, as a safe haven asset, has actually been declining for months now. Okay, the reason being it's because it's now shifted. Well, it's shifting towards more of an inflation play. Okay, so long story short, I just want to, for those of you who may have heard about the safe haven virtues of gold, well, that's more of a back seat now, and then it's more about the inflation outlook. Okay, so with that said, let's dive into some more details here. So yes, you have seen this downtrend in gold prices since the record high in August. That's the 2074.77 that you see right there in the candlestick chart on the right hand side of the page. Okay, now what could propel gold prices higher? Okay, so number one, you've got the Fed. This is the Federal Reserve. Their job, the central bank's job, is to try and number one, make sure that Americans are looking for work, they can get jobs. Okay, that's number one. And then also, well, 1B, there's 1A. 1B would be they're going to try and make sure that U.S. inflation, so prices, okay, are stable. Okay, now prices in the U.S. inflation has actually been quite weak. Now the Fed has said, look, we want to push U.S. inflation up. Why? Because it's a sign of a healthy economy. Okay, I won't get into an economics class with you guys, but just know that inflation, when prices rise, is actually a good thing for an economy. Okay, now as long as it's manageable. So that's what gold prices are trying to look out for. Okay, so over the past few months, even though you did see some risk aversion in the markets and the dollar kind of held steady, but the gold just kept declining because markets were like, well, where's the inflation going to come from? Like, Fed, hello, come on, hurry up, tell us how you're going to boost inflation. Okay, and that kind of information is not there yet. So hopefully by next week we could hear something out of the Fed about, hey, here's how we plan to actually boost inflation. Otherwise, gold prices have been ticking lower over the past few months. Okay, the other thing is that even though the dollar and gold are both traditionally seen as safe haven assets, right now we have been seeing, at least since March, this what we call a negative correlation. Okay, so where the dollar goes, gold is supposed to go the opposite way. Okay, so if the dollar goes up, gold goes down. If dollar goes down, gold is supposed to go up. Supposed to. Okay, so that's the narrative that we're working with. So if we see more dollar weakness, that's a second bullet point. Dollar goes down. If that negative correlation with gold still stays, that means gold is supposed to go up. Right? When? Well, we hope that the Fed will tell us when gold prices can start shooting higher again. Okay. The other one is bond yields. I won't go too much into this because this one is quite technical. So the idea is just know this: TINA. Okay, TINA. There is no alternative. So this is the concept within markets that when they're trying to put their billions and or trillions to work, they're going to try and find the asset class that gives them the most potential for gains, right? You are doing the same thing, right? So now, when say, if you look at gold prices, if you don't think they're going to go up, you're going to move the money somewhere else, right? So one of those somewhere else is U.S. Treasuries. Okay, it's arguably the safest place you can park your money. Okay, it's seen as a risk-free investment. U.S. Treasuries, U.S. bonds, bonds that the U.S. government issues. Okay, now so when the yields actually go down, they have been climbing up a little bit since July, August. Okay, they've been climbing up. And that's why you are seeing this decline in gold as well, because when the yields are going up on US bonds, markets are saying, hey, I can get some pretty good returns in US treasuries. I might take money out of gold. Okay, so now the opposite is true as well. So if we see yields going down, then markets are going to look for more alternatives. Like, well, if US treasuries are going to give me less than 1%, I might make a bet that, hey, gold could give me more than 1% returns. So then I might move back there. Okay, so just think about the alternatives, opportunity cost, the money flow. Where's the money flowing, and which can give you better returns? And of course, stocks is one of those options as well. All right, so those are the factors that we are looking with. I know in the past, it'd be a lot easier to say, yeah, gold, safe haven, risk on, so it's down. Right, but now it's a bit more complex, and I know gold is a favorite to trade among our clients. So I thought it is our duty to at least give you an outlook, but it's perhaps a bit more complicated right now. Okay, I mean, you could still subscribe to that notion, right? That, hey, it's a risk on time, gold is only going to go down now. And there are people in the market who say that as well. So for example, ETFs. And I know compliance is listening right now. So by way of disclosure, I have, yeah, I guess I should use the present tense. I do have holdings in the biggest gold ETF in the world, right? Now, it has seen the longest selling. Like, so in other words, funds are just pulling the money out of this ETF. Okay, the longest stretch since before President Trump became president. So before 2016. Okay, so we've been seeing a lot of people pull money out of these gold ETFs. Okay, I'm not gonna, again, this is not investment advice. I'm not telling you whether I'm staying put or I'm pulling out. This is not what this webinar is about. I'm just being truthful with you. I do have holdings in those gold ETFs, but based on the fundamental outlook, it can go both ways. Okay, we are outlining the different factors that I play. It is up to you to then make your own decisions. Okay, we are not offering investment advice. Let's be very clear about that. Okay, yeah. So there have been plenty of people who said, yeah, gold's done, we're out. Okay, they've been selling, they've been pulling out of this gold ETF, right? But from the fundamentals perspective, these could be some potential tailwinds that you see at the top 3 bullet points there. Okay, now to the flip side, okay, like I said, well, appreciating US dollar, like we're seeing today. Today is a great example. So the dollar index right now, as you speak, is back above that psychologically important 91 level. So it's gaining about 0.35%. So remember, opposite, gold is now down 0.4%. Okay, so you have that interplay that's still there as well. If you don't believe me, you can pull it up on your MT4 charts right now. You can pull up dollar index. You can pull up spot gold. Okay, so yeah, appreciating US dollar. If dollar goes up, gold goes down. Risk on more, like I mentioned. That's why we're seeing some selling out of those ETFs, and then rotation into other assets. So this ties into what I mentioned just a few seconds ago, and also a couple of minutes ago with the S&P 500, and also last month's webinar. Right? So we hold these webinars on the first Monday of every single month. And back then I also mentioned already, hey, watch that rotation play after the elections, right? So sure enough, when we saw energy and financials really soaring, and then some of these other sectors are lagging behind, in other words, rotation means investors are reallocating their money. They're pulling their money out of somewhere where they have it already, like gold, for example, like big tech, and they're putting their money into other places. That's the rotation. Okay, so if we see more of this rotation away from gold, that could really depress gold prices. Okay, so to wrap up this section, let me just go to the charts here. So I know you guys like your support and resistance levels, so here we go. Oh, hold on. If you look at the this one, right, this chart, so you note that back in around March or so, when gold prices dipped below its 200-day moving average, it only lasted, I think, no more than 2 weeks below that level. Then it came back up, right? So now we saw this dip, and sure enough, it's come back up again. Now, the key here is that gold prices then stay above that technical level, that 200-day support moving average. Again, that term moving average can be found on our glossary at FXTM.com. Just remember, top right-hand corner, look at market education. Okay, so this is a more zoomed in look at what gold prices could be doing, and we look at the support and resistance levels. Lukman, back me up on this. So we actually prepared all these charts last week, okay, on Wednesday. And I drew that 1848 resistance level even from last week, back when it was still in those green candles. And sure enough, bam, right? I just love it when I mean, we all do that. Lukman does that, I do that. I'm sure you listening right now, you do this as well. You just love it when you draw those charts just nice and like, yeah. So yeah, that 1848, sure enough, it's the resistance level for now. Otherwise, higher be the 1900 psychological level. Otherwise, if you go further up, it'll be the 1933, which is the top of the October range. Okay, support levels, 200-day simple moving average, that's key. Then 1764, then possibly 1745, which was the resistance level for where spot gold was trading around April and June. Okay, all right. So last but not least, we're going to go to a hot topic. It's a big one for this week, the pound. Over to you, Lukman.
Yeah, I mean, this webinar wouldn't be complete without speaking about the pound and Brexit. So, guys, I've got a number, 1,629. That's the exact amount of days it's been since we had that historic vote to leave the European Union on June 23rd, 2016. And just look at where we are right now. Over the past 4 years, there's been so many twists and turns, backs and forth, but it looks like things could be coming to an end. So much is going on, so let me bring everyone forward. So we've got less than 4 weeks until that 31st Brexit transition deadline, but talks are still on a knife edge as speaking right now. There's a lot of news flows, a lot of conflicting reports, but the key sticking points still remain around fisheries, which is a symbol of sovereignty in the UK, and the level playing field, something that we keep hearing about. But what I'm trying to say, people, is that right now fears are rising over the UK crashing out of the European Union with no deal by the end of the year, and this has been reflected in a pound, which has actually dropped over 150 pips against the dollar, and it's weakened against other currencies this morning. The Brexit is called Brexit Saga, a dark finale, and I think this is an inside joke between me and Han. When we had our podcast a few weeks back, I remember saying about how the Brexit has been an overextended TV series that's gone on and on and on, but it looks like we could be having a finale. Expectations remain mixed. Some people still feel that there could be a deal at the 11th hour. But when we're looking at the pound's valuation and sentiment overall, fears still remain quite elevated that the UK could actually leave the EU with no deal in place. I've got a really interesting chart right here, part of the perks of Bloomberg. It's called the Bloomberg Brexit Barometer. It's simply an index that tracks the economic well-being and health in the United Kingdom every day of the week. And, from somebody living in the UK, I kind of feel with this because since Brexit has been happening, the tension, the uncertainty, especially when COVID made an appearance back in March, as the index can show, sentiment is not really too positive in the United Kingdom. Looking at the potential headwinds for the pound, we've spoken about the tailwinds, the headwinds. So in the UK is set for COVID-19 vaccinations after the regulatory approval last week. So that's a real good tailwind for the British pound. It's boosting confidence that we could see some sort of normality in the UK in 2021. At the same time, national lockdowns have come to an end in the UK, and we've got a tiered system in place. To give you an example, I tried to go shopping over the weekend in the city to get Christmas gifts for family and friends. I had to turn back because everywhere was so packed. I didn't want to risk it. So there's optimism that the outlook for the UK economy could brighten probably in Q1. due to the end of the national lockdowns. But when we're looking at early data, like if you look at the GDP month on month, latest PMI figures, especially services PMI from the UK, retail sales, they're all pointing to that the UK may be heading for a double dip recession. So there are conflicting forces here pulling and tugging at the British pound. Let's take a look at the charts. So yeah, I've got my favorite WCRS. Had knows this very well. You know, this is one of the most my favorite functions from Bloomberg terminal. And since that EU vote, since that historic referendum vote back on 23rd of June 2016, we can see that the British pound has weakened considerably against every single G10 currency. It's weakened over 10% against the dollar. And I've got another chart just to show, the gyrations, the volatility that we've seen. And, for somebody living in the UK, the fact that things could come to an end, this really long saga could come to an end. It's really interesting because, so much has happened over the past 4 years. Talking technicals now. So I've got the pound US dollar on a weekly chart, updated for today. You can see that sharp decline. Okay, yeah, an appreciating dollar did play a role in a pound US dollar sharp descent, but overall, the pound is quite shaky in the G10 space. Prices are broken below that 1330 level, and it looks like 132 and 131 could be next key levels of interest. If the UK crashes out of the EU with no Brexit deal at the end of 2020, correct me if I'm wrong, Han, when we spoke in the podcast, I think we were speaking about levels of generation levels around 1.16, was it 1.16, 1.15? That's the level that
You
was
went with
called
1.14, I think. I was less. I mean, yeah, for me, sub 120, it's possible. I mean, it depends on what the dollar does, right? But I think you went as low as like 112, 114, something.
I think it was
Well,
115, 116, but yeah,
yeah.
it's
Well, you
so
can listen, all of you can listen to the podcast. It's there on record now. And you can find the podcast. It's called Markets Extra, and it is released every other Thursday. And you can find it on Spotify, on Amazon, on Google, all your favorite podcast platforms. So, yeah, the one with Lukman on Brexit, that was certainly a popular one. You can check it out to find out what he said exactly about the sub 120 cable. That's pound versus dollar, right? Yeah.
So looking at the technicals just to round up, lagging indicators like the moving average, the 100, 200, simple moving average, and MACD all point to the upside. Just to highlight what Hans said earlier, when we're speaking these technical jargons, literally just go to our website on the top right-hand corner, market education division area. We've got all educational articles in regards to moving averages, MACDs, leading and lagging indicators. So right now, the technicals on a weekly do point to further upside as long as prices can keep above that 1.31 support level. But just to let you all know where the pound US dollar concludes in 2020. I mean, I think pound's valuation as a whole will be heavily influenced by the developments over the next days and whether the UK leaves the European Union with a deal or no deal.
All right, great stuff. So I believe Lukman has got some polls for you guys, but in the meantime, I just want to show what we have on the website as Lukman gets his polls ready. Also,
Yeah.
folks, so don't forget that we have a Q&A tab. If you look in your toolbar, there is a tab for questions. So by all means, feel free to post your questions in there. I should have mentioned this earlier. Didn't mean for you guys to wait for now, but yeah, if you guys have questions, feel free to post them in the questions tab while we are waiting for Lukman to pull up his his polls. All right. Okay, yeah, there we go. Let's go ahead with that one then, and I'll show you guys the website later. But go ahead, Lukman.
So earlier we spoke about the S&P 500. I remember, like, when I look at the S&P 500, I like to really add color to how I describe things. And looking at its performance over the past few weeks is like bulls, bulls trampling over obstacles, just, trampling over through obstacles, regardless of the uncertain market environment. It looks like bulls really want to end 2020 on a high note. But of course, we've got things like rising COVID cases and this renewed tensions between the two largest economies. What do you guys think? Do you think the S&P 500 can hit that 3,800 level by the end of 2020? Okay, the results are coming through. So vote, guys. Do you think that S&P 500 could hit 3,800 by the end of 2020? Oh, wow. Okay. I see a lot of bulls in the crowd. Okay, so far so good. Most of you believe that the S&P 500 can hit 3,800 by the end of 2020. I think
let me see if I can show the results here. So I'm going to go ahead and close the polls. I'll give you 10 seconds more if you still want to have your say before I close. But sorry, I just wanted to see if I can show you guys the results for this poll. I may or may not be able to, but sorry, Lukman, I just wanted to get that out there. Okay, the polls are closed. Yeah, go ahead, Lukman. Let's see what happens. No, does it show?
Yes, there it is.
There we go. Yeah. Okay.
Okay.
All right. So over 60% of you said yes. 38% of you said no. So sorry, Lukman, go ahead with what you were saying about the S&P 500.
Yeah. So look, 63% of people, of you guys feel that okay, it's gonna hit 3,800. I think everyone's with Team Han, because Han, I think you follow the same thoughts that we are gonna have that Santa Claus Valley, or that explosion of risk on sentiment. Sometime this week or next week, that would really propel the S&P 500 to that 3,800 level. I'm going to be a contrarian here right now and think, what goes up must come down, as they say. Equity bulls could get tired. They could get tired. This renewed tensions between the United States and China could really be a thorn in the side of this positive market mood. But let's see how things play out.
Yeah, well, I actually said no as well. So if I didn't make this clear, again, this is not investment advice. This is just my thoughts. Yeah, I think the momentum might actually lag over the rest of the year. It's been quite the long year for bulls, right? So if you consider that, I mean, it's only 100 points away, so that's only a 2.7% from 2.7% gain from current levels. So on Friday, it closed at just below 3,700. So it's only another 100 points away, 2.7%. And if you take that into context, 2.7% would be the slowest or the smallest monthly gain in the S&P 500 since June, right? So I mean, yeah, I mean, I can see it going both ways, right? It's doable, 2.7%. Or what's 2.7% in a world when there is Tina, there is no alternative? Where else do you park your money? I can see that, but personally, I'll stick to, I think 3,800 might be a bit of a stretch. So that's what I mentioned earlier. All right, while waiting for questions, still no questions, let's fire off another poll then, Lukman, if we can.
Yeah, so another poll I've launched. Will the dollar index conclude 2020 below 90? So do you guys think the dollar index can conclude 2020 below 90? It's already been beaten black and blue over the past few weeks. More color to this, I think Hans already used to me adding color to when I describe market movements. So I see the dollar index like a boxer in a boxing ring, going against Mike Tyson, and it's on the final round right now. It's shaky. I think it just needs that knockout blow to tumble lower. But let's see. Probably it could rebound higher, before the end of the final round. But right now, the dollar index is looking quite shaky. So
all right. Yeah, it looks like the results are pretty stable now. We'll give you guys 10 more seconds before Lukman closes the poll and show what you guys are thinking about the dollar's outlook. Great stuff. Still no questions though. Wow. So Well, feel free to use this. If not, we might have to wait until next month for the next webinar.
I think everyone's holding their questions for the new year. They've, 2020 has been such a, it's been well a year. They're like, you know what? Let's hold these key questions and let's dish it out to them in 2021.
All right. So, Lukman, you want to go ahead and there we go. All right.
Wow,
So
50.
it's split. Okay. Pretty interesting. So for me, though, I think from a fundamental perspective, once again, it comes back to that inflation story. Okay. So the idea that, okay, we all know what inflation is, right? Inflation means the prices of the goods and services that you normally purchase, they are going up. Okay. Now, when the prices of those goods and services go up, the dollar's purchasing power weakens, right? That means with the $1, you can buy less goods and services because those prices have gone up. Okay, that's the inflation's effect on the dollar. So while I know in Lukman's performance, his presentation, I'm just trying to go through the notes again. But yeah, I would look at it from the inflation perspective as well, right? From the fundamental perspective. And that, I think, given what the Fed is doing, given what the US government is doing, I think that weaker dollar bias should remain intact. If it goes below 90, I think you have to go back to around the either 2016 or 2018 levels on the charts to see the next support level at 88, if I'm not mistaken.
80,
Yeah.
yeah,
So
that's correct.
yeah, 88 around there. Yeah.
Yeah.
Okay. Well, we've got time for a couple more polls since we got no questions. Seems like you guys love the polls a lot more than questions, so let's go for it.
So this is what with gold. So can gold return to 2000? Yeah, so I'll give it to you, Han. Han actually held an amazing podcast in regards to this. You guys should go listen to this. You could hear Han sing for the first time. He's got an amazing singing voice. But yeah, do you guys think that gold could return to 2000? Ooh.
After this, let me see if I can pull up the podcast.
I see only 31% of you have voted so far. So, guys, do you think gold can return to 2000? That 2000 psychological level? Ooh. Okay, we're gonna close the polls in 15 seconds. Okay, wow. So 75% of you all feel that gold can return to 2000. Look at that.
All right, pretty cool. Yeah, so again, I think it's a case of just waiting for what the Fed does, right? So we have to see how they actually plan to boost up US inflation there. So with that said, I just want to see if I can pull this up here on the screen. So I just want to show you guys where everything is at. So let me see. Well, we can forget about this questions panel since no one's asking questions. Yeah, so this is our page on Spotify, right? You can find us on again Spotify, also on the website. Now the website's a bit slow, so we have if you go back to the website. Where you can find the podcast is on here. You look for Market Analysis. And like I said, go to FXTM.com, look for the top right-hand side of the website. Now, for the fundamental stuff, you're going to look at market analysis. Lukman and myself and the team of researchers and analysts here, we update the website at least twice, if not 3 times, every single weekday, or at least when markets are open. Right, so you can find all our commentary there. If you hover over this, you will find daily market analysis, and we'll get to that in a bit. Otherwise, the podcast is here. right? Like I said, Markets Extra. I'm the host of that podcast, and I still can't get the name right. Shame on me. We've done episodes so with Lukman on Brexit is here. Who's afraid of the big Brexit? We did this last month or a couple of weeks ago. Very popular podcast. Numbers stream in, so you can check that out. Or if you're a bigger fan of gold, you can head on over to, like I said, Spotify, Amazon, all of these podcast platforms that you see, okay, whichever you prefer. And then you can hear Jamie's thoughts. Jamie is a market commentator. He writes extensively on the markets, and you can hear his thoughts on whether gold can hit 2000. Yeah, so that's where we're at. Should we do another poll, or should we wrap things up? I don't know. Are we getting
We've got
poll
one more.
fatigue here, or any questions? All
We've
right,
got
go for
one
the
more.
poll then.
But I don't think anybody wants this because, let's see. So I'm going to launch this poll. Is the United Kingdom heading towards a no-deal Brexit? I mean, I think one thing we covered in the podcast was that Brexit has become so elongated and it's become so drawn out that, people are like, Brexit what? Brexit this? So do you guys feel that the UK is heading towards a no-deal Brexit? Okay, we're going to close the
I mean, it's
poll.
great to see you guys. Yeah, it's great to see you guys participating. And so, it informs us that, I mean, granted, most of you will probably use technical analysis for your, 5, 15, those short-term charts, right? But, the fact that many of you are at least have an opinion on some of these macro events that are happening as well. It tells us that, hey, fundamentals has certainly a place in the at least in you guys' trading activities as well. Hey, so yeah, pretty cool.
Yeah.
Just want to hear your thoughts.
We're going to close the polls in 15 seconds. Okay.
All right, let's
So
see.
57% of you feel that the UK is heading towards a no-deal Brexit.
Wow, fascinating. Well, if you look at the FX options markets, so these are just ways that investors and traders can then try to get ahead of some anticipated results, right? As opposed to just looking at the spot price, right? I mean, of course, there are futures as well, there are options as well. So if you look at, say, the options market, I'm just going to pull up some live data here, see who has got a bigger following between those who expect a no-deal Brexit and those who don't expect a no-deal Brexit. I mean, but personally, Lukman, what do you think? I mean, you're the one with the most vested interest in this. Do you expect a no-deal Brexit?
Certainly. As much as I feel I don't want to admit it, I don't think there's going to be a no-deal Brexit. I think something is going to happen in the last minute, like one of those films where you just think everything is going to fall apart. Then there's just this deal at the last minute, and all of a sudden everything runs smooth. Because at the end of the day, I think both sides have a lot to lose. The UK and the European Union have a lot to lose. At the same time, they're both economic-wise not in really good positions due to COVID-19. So the idea of, especially the UK, reverting back to World Trade Organization rules in which it will result in higher quotas and tariffs for goods. This is something that's going to hit businesses, and the costs may be reflected back to consumers. So it's a vicious cycle. So I think at the end of the day, last minute, something might be sorted. So I'll be surprised if the UK actually leaves the European Union with no deal at the end of this 2020. And this is
Yeah,
why the
so
pound is trading where it's trading.
right. And then just to kind of quickly wrap things up, so we've got the options market. I wish I can show you this, but I don't think we've gotten clearance yet. But just so I can share with you, so if you look at the next 1 week, yeah, over the coming week, out of all the G10 currencies against the US dollar, markets are by far the most bearish on the pound. So if you look at, I mean, like, don't get too caught up on this, but if you look at the put options versus the call options, the put options on the pound versus the dollar is more than triple the second most bearish currency in the G10 space. That's the Norwegian kroner. Okay, so it shows that, while the spot prices are telling you, hey, it's still going up against the dollar, it's showing optimism that there will be a deal sorted. But if you look at the options markets, they are just protecting themselves just in case. You never know, man, right? So they're protecting themselves with those put options for the next 1 week, and it's over 3 times more than the second most bearish G10 currency against the dollar. That's the Norwegian kroner. So pretty fascinating stuff. That's what the markets are telling us, and we'll certainly keep you guys posted with our thoughts on the website, and also on all our various social media channels as well. So with that said, let me show you, or Lukman, do you want to share with them the social media channels as I put it up on the PowerPoint? If you
Sure.
close the
Let me
poll,
try to close my screen.
Yes, so again, we've got the podcast, we've got our daily reports that are on the website. Again, it's fxtm.com. Look for market analysis. That's a fundamental stuff, more news-driven, event-driven stuff. Like the one this morning, we didn't mention this. So there's the EU summit. Lukman, did you mention this? There's an EU summit starting this Thursday. So it's a big week for Europe, okay?
Yeah.
Hopefully by then, they've got the Brexit deal done, and they've also got this other deal for the stimulus plan. So plans to financially support the European economy. The EU members are fighting among each other. You got Poland and Hungary on one side, and then the rest of the EU on the other side, right? So they're fighting. So they're trying to come to a deal. Both those deals, Brexit and the stimulus plans, ideally would come to a head by this Thursday. So that's why I think the 1 week options on the pound dollar on cable, that's why it's so high, because if they don't strike a deal by then, then it's going to be really, really hard to try and do anything over the Christmas break. Okay, so December 10th, that's when the EU summit begins. So yeah, and so to keep up to date with the fundamental stuff that we produce, you can follow us on our social media sites, and Lukman will walk you through them.
Sure. So you could follow us. I mean, if you want to follow FXTM on Twitter, literally you just go on Twitter and do the Twitter handle at FXTM. forextime.com. If you want to follow us on YouTube, literally just go on YouTube and type FXTM, and the first result will take you to the FXTM channel. And you can also follow us on Facebook, in which we share all our market reports, market videos. It's time for me to do some shameless marketing. So on average on Mondays, I share my week in 60 seconds. This is shared on Twitter, on Facebook, and YouTube. At the same time, you can follow me on Twitter at _Lukman at FXTM. I think for Han, your Twitter handle is at _
no, it's at Han _FXTM. Yeah. So
yeah, at Han _FXTM. So yeah, if you guys have any questions in regards to the markets, please be free to reach out to us either on Twitter, or you can even ask the questions on the Facebook website. And yeah, sure to watch our videos and tune into our podcasts.
All right. So I guess unfortunately we got a question that just came in about the analysis of Brexit and how it affects the pound, right? So I think we've already shared that. Perhaps the question came in as we were sharing that extensive analysis on the pound and Brexit. In case you need to review any of this, this will be posted. This webinar will be posted on our YouTube channel as well. So you give it about a day or two, and it'll be back up on there. All right. So thank you all so much for attending. I know we have gone well over our allocated time, but thank you so much for sticking it out with us. In fact, we had more attendees come in the latter part than those who actually started off with this. All right. So yeah, I appreciate the time, and do feel free to reach out to us if you ever have any questions from a fundamental perspective on the markets. Lukman, what say you?
Yeah, I mean, Han said it all. It's always a pleasure. I just want to kind of use this opportunity to wish everybody a Merry Christmas, Happy New Year. And again, please give yourself all a pat on the back. It's been so much has happened in 2020. It's been incredibly amazing. Yeah, happy trading, and we'll see you all in 2021 for our next monthly outlook.